Happy Friday, dividend growth stock investors. It's Colby, the DGI Crab, coming at you like I do every single Friday, taking a look at each of the stocks in the four tiers to see where the undervalued bargains lie here at the end of the week. And I've got to tell you, you guys, the stock market's been a little bit down since the turn of the year. And that has presented a lot of interesting buying opportunities amongst the 60 stocks that this channel focuses on. That is right. This stock is primarily focused with 60 individual dividend growth stocks split into four separate tiers based on your age range, which I believe is the most important metric for a dividend growth stock investor to take into consideration: your age and timeline and how you need to acquire that passive income in order to retire financially free and still get plenty of dividend raises, even when you're at the point where you're no longer investing new money or reinvesting those dividends. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. And of course, for anyone who is new, if you're not, feel free to skip past. But my strategy is as follows: 50% of my money goes into age-appropriate ETFs, and I'm looking for single stocks that are yielding 30% or more above their 4-year average yield, with the exception of my top 10 favorite stocks, just my personal preference. If any of those are yielding 20% or more above their 4-year average, I go ahead and make those a priority. And then I remain within my age tier, tier 2, which we'll get to here in a moment, unless there happens to be a stock in a different tier yielding at least 50% higher than its 4-year average yield. We definitely have multiple stocks yielding 50% higher than their 4-year average yield across tiers, so that's absolutely exciting. It gives us lots of options in our bargain hunting adventures here. And if I don't have anything that's viable within my tier at the time, I will just invest more money that week into ETFs. That'll ensure that I've got even more than 50% of my money allocated into those ETFs, which is where I want, the bulk of that investment capital to come from. So everyone, what we're looking at here is, first off, tier 1. These are super dividend compounders for the younger investors aged 18 to 30, where we're looking for lower starting yield generally as a group, but very rapid 10% or much better, hopefully, cumulative dividend growth out of those stocks, because this group of investors is going to have the most amount of time to let those double-digit dividend increases year over year really compound and snowball into an impressive passive income machine. Nike, of course, has been down in the dumps for a while now. Nothing new there. But interestingly enough, Nordson continues to slide. It dipped down below $200 this week. I think that is just an absolute steal. Nordson yielding above 1.5%. I don't think you can go wrong with this dividend king at those prices. Both of these stocks are in that 50% or more range, meaning that any age range, in my opinion, could be adding to these if they wanted to. But the older you are, the longer or the shorter amount of time that you have in the market. So some of those double-digit annual dividend increases won't be as effective for the older folks who just won't have as much time in the market. But two excellent buys here remain. In tier 2, the age 31 to 41-year-old investors, this 41-year-old crab's got another year to go in this group. Hershey is still the absolute bargain of the group here. I've been buying Hershey for months, definitely continuing to build up that Hershey position. If they end up being acquired by Mondelez, then oh well, I guess I'll have Mondelez shares at that point, or I can reevaluate what I want to do there. Or maybe they pay out in the shareholders in cash. Who knows? Mondelez has wanted to acquire Hershey before. I don't think that that's necessarily something that's likely to happen this time around, but if it does, I'll cross that bridge when I come to it. In the meantime, I think Hershey is a steal down here in the 150s. I'm going to keep adding to that position. And then multiple new stocks in that 30% or more buy zone have entered the fray here. American States Water, which crept into this group last week, continues to fall. It's now threatening to fall below $70 a share. I did check across the market at other utilities like AWK, SJW, etc. A lot of them are down in the dumps right now. I honestly don't know exactly why that is at this point in time, but American States Water, in my opinion, is a steal, especially yielding above 2.5%. And then McCormick and Next Era Energy have both entered the fray here as good values. McCormick down in the low 70s, definitely like it here. And Next Era Energy down here at $67. I missed my opportunity to add Next Era Energy to the DGI Crab Channel portfolio this week. There were just too many other things to buy at this point in time. But if Next Era stays down here next week, I will be adding this to the DGI Crab Channel portfolio next week without question. Really like this group of 5. Plenty of options to choose from in the tier 2s. The tier 3s, the 42 to 53-year-old investors, we're looking more at 3 to 4% starting yield and mid to high single-digit dividend increases year over year. Archer Daniels Midland has been at the top of the pile here for a while now. I'm definitely still adding to Archer Daniels Midland. I noticed that Burt and Lanny over at the Dividend Diplomats over the last month have reported that they have been adding some Archer Daniels Midland as well. They've got really big positions in that company. If you haven't checked out the Dividend Diplomats and Burt and Lanny, definitely go and give them a view. And then Hormel, American Tower, Pepsi, and Genuine Parts Company, all in that buy zone. Pepsi, one of my top 10 favorite stocks. This is one that just has to get 20% or higher for me to want to start buying it. Pepsi is one of my big priorities right now as an ad, even though I'm not technically in tier 3 just yet. If Pepsi is trading this cheap, it is time to load the boat, if you ask me. And then Johnson & Johnson, another of my top 10, still in the buy zone for it as well. Plenty of fear in the pharmaceutical stock industry right now. People wondering what RFK Jr. might do to that space. I think that while maybe a little bit of healthy concern might be of interest, you might want to pay attention, obviously, anytime a new administration comes in to see what they're up to, what their policies will be like. It's just kind of a stretch for me to think that it's going to have such a major impact on Johnson & Johnson that they're not going to continue to be the steady Eddie stock that they have been for decades now, a long-standing dividend king with very consistent dividend increases year over year. Tier 4, 54 and older investors, we're looking more for higher yield, but not totally throwing growth out the window. 5% or better starting yield, hopefully, as a group, with at least 2 to 4% year-over-year dividend growth, because when you're not reinvesting your dividends anymore, you do still want to get a raise to that passive income somewhere. Realty income, I've said in the past, when realty income's yielding above 6%, I think that that's just about good enough if you wanted to start adding some real estate to that portfolio. Technically, realty income for me could stand to get maybe $1 a share cheaper, or maybe even just dip below 51 before it officially hits that 30% mark. But if you're adding realty income yielding 6% or better, I think you're doing a pretty good job of adding a blue chip real estate stock at low valuations. Real estate has not recovered very much lately, despite a couple of Fed rate cuts in 2024. We'll see how much more the Fed decides to cut rates in 2025, but REITs are still having a hard time, and now NNN REIT is creeping up a little bit now. It's approaching the buy zone, yielding almost exactly what realty income is, 6.10 versus 6.13. Both very, very good REITs, long track records of increasing dividends consistently over multiple decades. Could be a good time to add real estate to that portfolio. And then even Verizon is starting to get a little bit closer. I'm not quite ready to go add Verizon just yet, but you can get qualified, meaning tax advantage, dividend income better than 7% starting yield right now, and it pays out on the second month of every quarter. So it could be a nice complement to some ETFs that you might have in your portfolio that largely pay out in the third month of the quarter. So just kind of something to keep in mind. Keep an eye on Verizon. I'd probably like it to get a little bit lower, but it is getting pretty interesting here as it's dropping down in more and more into the mid 30s. And then the strategy for me is as follows for the week. Loads and loads of options here. I am a spread the love around kind of a guy when it comes to the individual single stocks. I don't necessarily mind smaller positions so long as they are blue chip companies like these. And I just want to make sure that I am adding to any of those positions when they're undervalued, even if it's just a little bit of money. So that way I can increase that passive income. And if maybe I am wrong on my projections on a couple of them, I think I'll be right on the majority of them, and it will still have really good results overall. So for tier one, about 25% into the S&P 500, 15% small cap value, 5% dividend appreciation, and 5% international. Tier 2, same 4 ETFs, just a different weighting with the dividend appreciation getting the bulk of the money with a little less emphasis on S&P 500 and small cap. Tier 3, if I was in Tier 3 right now, this is how I would weight it. You cannot, can't deny the results here. SCHD has been the best between it, VYM, and DHS. I still really like all three. But for right now, I think that's where I'd be putting the bulk of my money in, while also trickling money into VYM and DHS for some added diversification. And then for tier 4, SPYD for high yields, big company exposure, and then high yield bonds, preferred shares, MLPs, covered call ETFs, Devo, JEPI, SPYI. And then, of course, 5% international across the board. And then look at the allocations here. If you wanted to sort of hit everything that was in the undervalued, the tier 1 group, 15 each, Nike, Nordson, the undervalued ones within that tier, 5 each into Pepsi and J&J, my top 10 favorites, and then 5 Hershey 580M, 2 of them the top yielding one in each of the other 2 tiers that are 50% or more above the 4-year average. This would cover all of that. Now for tier 2, there's so many options here available for tier 2 that you literally could do 5% into everything that's in the buy zone within tier 2, Hershey, McCormick, AWR, NextEra, Target, hit Pepsi and J&J to cover those top 10 favorites, and then also get Nike, Nordson, ADM to round out the 50% or better super bargains. So that's definitely spreading the love around a little bit, but again, you got to build up a lot of positions, because if you go all in on one of them and you're wrong, then that can lead you to not having as good of a result. If you go all in and you're right, then you have amazing results. But I like to have the diversification, and I don't mind adding to any of these positions so long as it looks like I'm getting a good deal. And then for tier 3, I've basically got almost the same thing as I've got from tier 2, different group of stocks. I'm going to emphasize Pepsi at 10%, but then 5 into J&J, ADM, Hormel, GPC, AMT, all of the tier 3 ones that are in the buy zone, and then hitting those 50% super bargains, Nike, Hershey, and Nordson, and the other tiers would round that out. And then for the tier 4s, of course, you could definitely go with Realty Income, and I think Pepsi would also be a good value here. So I would just say double down on your ETFs, because there's not a ton of value in those tier 4 stocks still. So there's no shame in just adding to those high yield monthly payers. And then that extra 5% left over, because I don't double down on the international, I'd say just pick between Pepsi or Realty Income, and you've got yourself a pretty good deal as far as that goes. And then a quick check-in on the DGI Crab portfolio. This one's rounding out pretty well right now. I've got that up to 1,300 steadily doing $100 a week. It's paid out a little bit in dividends so far. This number is going to grow quite a bit as time goes on. Down a bit still, but it's because I continue to add on to the ones that are down, and the portfolio hasn't been around long enough to see a lot of those stocks recover just yet. So I'm not concerned about that one way or the other. VIG is the one I have invested the most in, with Hershey being number 2 and at VOO number 3. And then Pepsi just hit $100 invested in this week. So that's another tier video for you guys. Let me know which stocks you are buying, and I will see you on the next one. Take care and have a great weekend.